thinking about this theme of new products and solutions that are being created to meet the needs of investor preferences, let's move along into our panel discussion on cryptocurrency and really how investors should think about crypto and digital assets in light of recent events and what opportunities and challenges those events actually present for the future of the industry. Now, our panel will feature Tom Jessup, President of Digital Assets at Fidelity, Brian Estes, CEO and CIO at Off the Chain Capital, and Dr. Jimmy Lenz, Director of the Master of Engineering in FinTech at Duke University. Moderating the conversation will be Brendan Winkler, Managing Director of Digital Assets and Blockchain at Ernst & Young. Tom, Brian, Jimmy, Brendan, thank you all so much for joining us today. Really looking forward to this conversation. It's got a bit of a follow-up, actually, to a crypto panel we did last year, and seeing where we're at this year and where we're going in the future.
Yeah. So, Ed, thank you. And thank you for the quick intro, and good afternoon, everyone, and thank you for joining us. We've creatively titled this panel session Tales from the Crypto. And I think it's going to be a very interesting topic as we move forward. And I think we're going to diverge from the crypto topic just a little bit. But as Ed mentioned, my name is Brendan Winkler. I'm a managing director within EY's Wealth and Asset Management Consulting practice, also leading our digital assets and blockchain initiatives across that market segment. So that involves, just very briefly, working with traditional financial institutions, such as large asset managers, asset owners, hedge funds, private equity firms, RIAs, to help them navigate their entry into the digital asset markets, create or obtain the capabilities that they need in order to access those markets or build products and services to be able to support investor demand for those investment products and other. Also work with crypto natives to help build out new capabilities to bridge the both traditional financial infrastructure and the crypto native infrastructure. Think prime brokerage, think lending, think custody, et cetera. And do quite a bit of work on blockchain as infrastructure, specifically tokenization, in helping a lot of our large asset management clients navigate entry into that space, developing products and other. But most importantly, I have the privilege of moderating what we think is going to be an exceptionally informative panel today and on a variety of topics within the realm of digital assets and blockchain, specifically tailored for our wealth and asset management attendees. And so, as Ed mentioned, this panel is going to include three tremendous thought leaders across the digital assets and blockchain space, represented by Tom, Brian, and Dr. Lenz. And we've done some brief intros, so I won't regurgitate their roles, but I'll give them a chance in a moment to kind of define for themselves their roles, their businesses, their perspectives, and then we'll move forward. But as I mentioned, we're not going to just focus on crypto today. We're going to work through what does the market currently look like? Where have we come from a digital asset and cryptocurrency market perspective? We're in the middle of a crypto winter, or maybe towards the tail end. How are investors and service providers positioning themselves for the next leg up? How are institutions and retail investors engaging the market? What products and services and market access are they looking for? And then we're going to move into a bit of the portfolio management realm. So an introduction to how Bitcoin could potentially be part of a diversified portfolio. And thank Brian for his insights on this and the entire group. We'll also think through how we can value those assets in the context of how they may be interesting investment options. And then we'll move into innovation. And what is the potential of digital assets and blockchain and Web3 overall? And how might it transform financial services as we move forward? And of course, we're going to hit on the hot topic that everybody loves to speak about, and it's the current regulatory environment, both in the US and abroad, what we're seeing and how that regulatory environment can influence innovation across this landscape. So really looking forward to this discussion, but without further delay, what I'd like to do to kick things off is really, maybe Tom, I'll start with you, but hand it over to our panelists to provide a brief overview of their businesses, their focus areas within the digital assets and blockchain space, and maybe some general higher level perspectives to get us started. So Tom, can I hand you the mic?
Great. Thank you, Brendan, and thanks everyone for having me today. So I'm Tom Jessup. I'm president of Fidelity Digital Assets. I think Fidelity Investments needs no introduction. I think all of you know who we are, but maybe you don't know what we're doing in digital assets and how we got here. So I'll try to be brief, but Fidelity has a very long history of innovation, one that I didn't really realize until I joined the company in 2018. We have a group that invests in basic technology R&D. It's called the Fidelity Center for Applied Technology. Right now, they're looking at things like quantum computing and virtual and augmented reality. But, back in 2015, they were looking at blockchain technology. And we started mining Bitcoin in 2015, started running nodes of various blockchain networks, starting with the Bitcoin blockchain and then the Ethereum network. We ran user experience experiments in the company cafeteria. So there are funny stories about, the most expensive bagel someone bought in 2016, 17 with Bitcoin. And we always felt that blockchain technology writ large is potentially a new operating system for financial services, perhaps the most significant real innovation in financial services in decades, if not longer. If we think about a lot of fintech innovation these days, think about payment platforms, it really is better user experience over what is a fairly old system for payments and banking. And so as a large financial services company, we felt compelled to begin researching this space and trying to figure out what it meant for our business. All that R&D manifested itself in a commercial business, which we launched a couple of years ago called Fidelity Digital Assets, initially focusing on providing secure custody and trade execution services to institutions, primarily family offices, hedge funds, with some increasing frequency corporations now and more traditional investors. But we always felt back to that original vision at some level of maturity, this would be a core capability that would underlie products and services that we would deliver to our personal investing clients, our workplace clients, and many other client segments that Fidelity serves in traditional asset classes. So we've gone from being a standalone institutional service provider to, as recently as last year, launching for a 401k product for plan sponsors to include Bitcoin and 401ks. We call that the digital asset account. Late last year, we also quietly launched what we call Fidelity Crypto, which allows our personal investing clients to buy and sell digital assets and see those balances alongside all of the other assets that they keep at Fidelity. And I think central to our view going forward is that this is another asset class. Our clients demand access to this, and maybe most importantly, we want to see this asset class integrated with the other assets that they own. While there are many crypto service providers that are building crypto native experiences, we believe strongly, not to the exclusion of those experiences, that there's a much larger body of investors and many of our customers that want to be able to access this in a highly secure and safe way through a trusted provider, the same way they would trade stocks, bonds, and other instruments. And that really is kind of our North Star as the space develops.
Great. Thank you, Tom. Brian?
Hi, thanks for having me. I'm Brian Estes. I'm the CEO and CIO of Off the Chain Capital. We're a private investment fund in the blockchain space, established in 2016. If you look at what we do, is we're looking for weird and strange ways to buy Bitcoin at a discount. So we're Bitcoin maxis at heart, and so we buy Bitcoin through bankruptcy court proceedings. We find public companies that have Bitcoin on their balance sheet where their market cap is below their Bitcoin balance. And so, we found all these different ways to find Bitcoin at a discount. The ultimate goal is to outperform Bitcoin in our fund. And we believe the best way to do that is to be a traditional Benjamin Graham, Warren Buffett value investor in the blockchain space. The history of the fund, like I said, started in 2016. Between 2016 and 2021, it was the number one performing blockchain fund. Last year we underperformed, but hopefully we'll get back on track here. And so we have about 230 LPs in the fund. And I started in the industry back in 2014. Like you said, I come from traditional finance. Since this is a St. Louis-based webinar, I started in St. Louis at a company called A.G. Edwards & Sons when I was 22 as a retail stockbroker. I was with them for 14 years. And then in 2004, left and started my own RIA, ran that for 10 years. And then in 2014, I learned about Bitcoin and ended up selling my practice and started building and financing blockchain companies back in 2014.
Excellent. Thank you, Brian. Dr. Lenz.
Hey, Brandon, it's Jimmy. Always Jimmy, please. It's only a doctor to put the fear of God into students. But it's Olin. I received my master's here and my doctorate, and so it's always fun to come back and have the opportunity to participate in things like this. And what a great topic. So as mentioned, I'm here at Duke now. I run two of the graduate programs in the engineering school, the Master of Engineering in Financial Technology, which is now the largest of its kind in the United States, and the Master of Engineering in Cybersecurity. In addition to that, I run a digital asset lab here at Duke. We have published quite a bit in mentioning, Tom mentioned valuations, and Brian did too. We've done quite a bit in peer-reviewed journals. And so we have several articles out there now, and I continue to do a lot of research, in particular, the impact of derivatives on digital assets. We run digital assets at Duke, but my perspective is kind of like you guys. I come from traditional finance. I was in almost 3 decades in traditional finance, including a stint at in St. Louis, 2 stints actually. I was the co-president and chief operating officer of Bridge Trading when Reuters bought us, and I was the chief risk officer for Wells Fargo Advisors, the retail and brokerage firm and the clearing firms. So it's always nice to come back. The digital asset space is something that I'm fascinated with. I probably in my lifetime have never seen so much excitement about anything, including the internet, as I see around digital assets and blockchain technology. That may be a feature of my age. I don't know. But it's seems to have elicited a lot of innovation. And I think that's one of the reasons that we're here. So I'm very fascinated with it. I've been teaching blockchain technology both in a business school and an engineering school since about 2017. And now we have a couple of different classes in the subject here. Excellent.
Thank you, Jimmy. And we'll go with Jimmy from now on. I appreciate that.
Thank you.
So maybe I'll kick things off at just an initial question to the panelists, and we'll touch on the topics we mentioned, but we'll keep this free flowing. And of course, we want to hear your questions as well. So we'll carve out time for that toward the latter section of the panel. But maybe with this, from mid-2020 through Q2 2022, we saw a surge in retail and institutional interest in investment in the digital asset space. And that we saw cryptocurrency trading volumes skyrocket along with market capitalizations, Bitcoin and Ethereum specifically. We saw VC investment within the sector skyrocket. And I think most importantly, we saw institutional investment in digital assets alongside development of related products and services to bridge the ecosystems. Of course, then came a series of events that pushed us into the current crypto winter, whether it be lending units failing, large hedge funds failing, or large funds in general, crypto native funds failing, and of course, the fall of FTX. But with that, just to get things off, I'd love to hear the panel's views on how the market environment, investor demand for exposure to cryptocurrencies or the digital assets in general has shifted since the events of 2022. And maybe Tom, I'll direct to you to start, and then we'll move through the panel.
Sure. Yeah, I tend to think about the events of the past year as crypto's .com moment meeting its equivalent of the global financial crisis. As many of you know, crypto is a relatively new industry. The Bitcoin white paper was published in late 2008, 2009. The market has experienced several significant boom bust cycles with drawdowns of 60, 70%. I've lost track. I mean, Brian might know, but it's probably the 5th or 6th. What was different this time is that I think things were precipitated by tightening macro conditions about a year and a half ago after Bitcoin peaked at about 69,000. And that sort of receding tide from a pricing standpoint exposed, I think, a lot of speculation and other things, bad business models that have been funded. And we saw this cascading effect culminating in the failure of many CeFi platforms. I want to point out that these were companies engaged in the crypto ecosystem that failed, not the protocols themselves. And where we are now is that trading volumes are probably down 50% from the peak. The other thing we've seen is that there was an explosion of interest in altcoins or the long tail assets. We had seen in our business tremendous demand for those assets. Now I think something like 70 plus 80% of trading volume on a daily basis is in Bitcoin and Ether. And then, as Brendan noted, we've also seen a pretty significant pullback in terms of venture funding. So while things, are certainly a lot later and less frenetic than they were, 18 months ago, we do see that the people that are building businesses are still committed to the space and building. There have been a couple of industry conferences this past week that were surprisingly well attended, despite where the market is. And I think this is a classic example of trying to focus on the long-term promise of the technology in the space and trying not to focus on some of the short-term machinations in price. And it does feel with all of this building going on, this will look like yet another classic drawdown cycle in the digital asset space, which many of us in the space have seen before. So lower levels of activity, more concentrated. But interest is still there, albeit at a lower level, and the builders are still building.
Yeah. Thank you. Brian, any additional perspectives?
Yeah, I agree with Tom. Warren Buffett likes to say, when the tide goes out, you see you swimming naked. And the tide went out last year. And so the companies that were leveraged up, or their business models completely blew up. So those were like BlockFi, Celsius, Three Arrows, Genesis Lending. Lending in the the blockchain space or Bitcoin space, it proved that doesn't work. So that model got eliminated out of the ecosystem. This is my fourth crypto winter. The first one was back in 2014 when I first started. I felt the pain. I lost half of the value of my investments back in 2014, right after I got started. As my risk hedge, I actually went to got my MBA at Olin just in case the whole thing went to zero. I'd have an MBA to go work at a bank or something. But yeah, it's normal for this industry to have volatility. We're in this what's called price discovery mode of blockchain and Bitcoin. The world just doesn't know what this technology is worth. And as more people become educated about the industry, about the technology, about blockchain, then we'll be able to fully value what this technology is worth. What I think it's worth, I think it's worth more than the internet itself. Finance and blockchain, I think once the world discovers the value of that, then it's going to exceed the value of internet. And so what's the value of the internet? And that's really the question.
Thank you. Jimmy, any thoughts?
Yeah, no, I think both the Brian and Tom were right on point. I think those that came for the cash are gone. Those with long-term vision, that's who you see, or that are still here, and it's the builders. It's folks that are building. I think a lot of the practical applications. The Mike Cagneys of the world at Provenance, the Todd Zieglers at Truckcoin. Those kinds of people that are building very practical things. Sometimes they're not as sexy as apes on NFTs, but they're practical applications that people can identify with. And so, over the last couple of years, we have seen a lot of those things fall off. Is just spot on. The one thing I would say, though, that's different is retail behavior is very, very different. And we actually wrote a whole paper around this. In the .com boom, when everything started going south quick, the NASDAQ market lost about 85% of its value. It took 15 years for it to come back. All right. And people were fleeing everything that had to do with .com, with technology, NASDAQ in general. We don't see that same kind of behavior with digital assets. Most of the digital assets, in particular the larger ones that everybody's mentioning, when you see a dip, what happens? We actually see more wallets being made, right? More people are getting in. So the behavior around investors is very, very different than what we've seen in other asset classes, which I think is very telling. And that's one of the reasons that I think this is a very unique asset class, trying to classify it in terms of traditional assets, either a commodity or a security. Completely wrong. It doesn't have to be either.
Yeah. Fantastic views. And I think one theme that resonated with me that I think we heard throughout is that I think, Jimmy, to your point, Tommy mentioned this, Brian, you did as well. The builders continue to build. There's a long-term commitment and a long-term view of value in the technology. And there's resiliency that we have not seen. I think, Jimmy, to your point, we saw after the .com bust. So it's a really nice segue into kind of a related topic, but WeDY did a institutional investor survey on digital assets and blockchain just this past March. And what we found, and it's very consistent with what we heard thematically from the prior responses, 60% of respondents noted that while the near-term events in the market have impacted their investment plans in the short term across digital assets, 93% believed in the long-term value of blockchain tech and digital assets overall. So again, leading to that resiliency. So that would be largely bullish, if you will, for the sector overall, the tech and on the investment sides. And with that, I'm just curious, how are you viewing, in light of the recent events, and we mentioned resiliency, but how are a lot of buy side or sell side participants, inclusive of wealth managers, banks, adjusting their strategies in your view, or from your perceptions in the market and from your discussions? They're adjusting their plans to either enter the market or develop new solutions and services to support. So I'll start there, and Tom, if you'd like to start, or Brian.
Brian, do you want to go first?
No, go ahead, Tom.
Yeah. So yeah, I think a couple of things. So we've done some institutional surveys as well, and I think we year on year we've done surveys for 3 years, and we see consistent interest in the space. What I would say though is it really depends on what class of investors you're looking at. Jimmy spoke a little bit about retail investors tend to be pretty resilient. On the institutional side, if you segment the market, looking at what I would call maybe the more risk-seeking investors, the family offices, the hedge funds, high net worth individuals, they're still committed to the space and adding. You think the bulk of the money, your pensions, your endowments, your more traditional asset managers, in some respects, I think the recent events have probably pushed them off a little bit further in terms of coming into the space. About 85% of them are concerned about the lack of regulatory clarity. And maybe more interestingly, when you survey service providers that provide digital asset services to those types of investors, or would, about 75% of those people say the same thing, i.e. that these large investors are not going to come in until we have reg clarity. Having said that, when we speak to investors of all types, we do see a lot more knowledge about the space. They understand, Bitcoin really is sort of the gateway digital asset. It is the thing that is the largest market cap asset. It really forces people to understand the technology and its promise. And as a result of understanding Bitcoin, they understand the technology and start thinking about other possibilities. But I think, again, with a certain set of clients, we see pretty consistent interest. I think for another set of institutional clients, I think they're going to wait for some reg clarity before they step in. Ron, I don't know what you think from your perspective.
Yeah, there's still a lot of reputational and career risk for CIOs to allocate to this, asset class. So we've been meeting with a number of endowments and foundations, especially at universities. And, the CIOs, they've taken 20 to 30 years to get to that position, and they just don't want to take the career risk by putting their neck on the line to allocate to Bitcoin. And so we've been talking to them for 6 to 7 years now, and they're still very hesitant. But you do see companies like Fidelity, MetLife allocated to Bitcoin about 2 years ago. I think they bought $100 million worth of Bitcoin. You see some public corporations buying Bitcoin, like Tesla and MicroStrategy. So MicroStrategy is a great example. Michael Saylor, who started that company 30 years ago, he was early into the .com, and he was buying up domain names 30 years ago. He bought Mike.com, Michael.com, Hope.com, Strategy.com, Voice.com. He sold Voice.com about 1.5 years ago for $30 million. He paid $30 for it and sold it for $30 million 30 years later. He understands the value of digital property, scarce digital property. And that's why he and MicroStrategy made such a big commitment to Bitcoin. They own 140,000 Bitcoin at MicroStrategy, which is a public company. If you look at the asset managers that have allocated to MicroStrategy, American Funds, which is Capital Group, they're a very conservative asset manager. They own 16% of MicroStrategy. They're the largest shareholder. Bank of America started accumulating MicroStrategy stock over the last few months. They're one of the top 5 shareholders. And then we see like Warren Buffett, who has been bad-mouthing Bitcoin and crypto for a number of years. Warren Buffett actually owns Bitcoin. If you think about it, Warren Buffett's company, I blank.
Berkshire?
Yeah, Berkshire Hathaway. Berkshire Hathaway owns about 10% of Bank of America. Bank of America is one of the largest shareholders of MicroStrategy. And if you do the math on that, Warren Buffett actually owns 480 Bitcoin through MicroStrategy. So, this will eventually permeate through the industry. And I think eventually everybody will, make an allocation to Bitcoin because it's the new digital property. It's the new, like I said, .com. And we just have to wait for the next 5, 10, 20 years for the rest of the world to catch up and understand how scarce this digital property is, which we call Bitcoin.
I think that's a very interesting point you made, Brian, about, I think a lot of investors believe the only way to gain exposure to the market, digital assets, crypto market, is through direct ownership, meaning spot crypto, if you will. But what's proliferated, and I think maybe this is a topic we can talk about at later on, what it feels like that it's proliferated the opportunities to gain exposure through registered products, various ETFs, whether derivatives backed or investing in companies with significant exposure is really proliferated. And it's really created a new opportunity to gain access, but risk reward potential diversification opportunity as well, leveraging digital assets. So I think that's fascinating. I don't want to hop yet. Jimmy, any further perspectives?
I think, I'm seeing some interesting things on the institutional side. You've seen Onyx continues to grow, JP Morgan's blockchain division. I know you're very familiar with them, Brendan. Tokenization. I mean, we've heard so many institutions talk about this. Larry Fink, 50 interviews with this is the future. We're seeing more and more again of that application. And so, kind of departing a little bit, kind of what Brian was saying, away from maybe direct investment in the in digital assets, and it's more towards some of the things that digital assets will facilitate. And we're seeing, seems like more and more of that kind of thing going on. I think going forward, and I'm contacted by institutions constantly that are looking for us to do experiments or to model certain things. I think that is coming. I would disagree, I think, with Brian a little bit. I don't think we're waiting for the rest of the world to catch up. The rest of the world is unfortunately bypassing the United States in this because of the regulatory environment, which is, questioning and onerous at best. But we are seeing very overtly companies deciding not to build in the United States or leaving the United States. They're not getting out of the business. They're just leaving the United States. And to me, that could be one of the things that is, in particular, if you're here in the U.S., could be one of the things that affects blockchain and digital assets going forward here more than anything else, is this kind of unknown and amorphous regulatory environment.
Mm-hmm. So I think that, Jimmy, I think that's a great point. Also, I was going to save the regulatory fund for later. Maybe we hop in right now. But I think one of the things I'll say is certainly, just if you pay attention to these markets, you read the news in the markets, everything you've said is spot on. And I had the opportunity to attend one industry conference last week, which again, very, very productive. But thematically, the major theme that came out of there was tokenization was one of them, and the importance and the desire to begin experimenting. There's a lot of leaders in that space and a lot of fast followers, but the regulatory environment and the uncertainty, as Tom mentioned, and the, I guess, it's not necessarily, I think to your point, a reg arbitrage move offshore but it's a need from a business and innovation perspective. But just wanted to, maybe ask you and Jimmy, we can dig in a little bit. You had mentioned just how does, I guess, the regulatory environment in the U.S. relative to, say, Europe, where we have MiCA legislation to provide a little bit more clarity, how is that impacting innovation overall here? Maybe not just now, but the long term. What are the long-term implications of not having maybe an environment from a reg perspective, or a perceived environment from a reg perspective that's supportive of the digital asset and blockchain community?
Yeah, I co-authored a editorial in American Banker just this week on the subject of innovation and the need to kind of incentivize that here in the U.S. Through something like a federal sandbox. Right now, there are about a dozen states that have fintech sandboxes, which digital assets play in, but nobody operates under state law, right? Everybody operates under federal law. And I think the lack of clarity coming out of the U.S. And this idea where we have to consider digital assets a commodity or a security. Maybe it's neither. I would argue it's neither. But the lack of any clarity, and even yesterday when the new hedge fund guidelines came out, The SEC had promised to put a definition of digital assets in there, and yet they backed off on that at the last minute and just put a footnote, we're not ready. Well, I mean, they are out there, they are having enforcement actions all over the place, and yet they don't even want to define, at a very, very basic level, that. And so I think that unknown regulatory environment, and certainly, I've been under a lot of regulated entities when I was in industry, but never to this extent where you are constantly guessing what's right and what's wrong. And so we are seeing companies leave. There are exchanges that have left the United States, not under any sort of regulatory obligation to do so, not under any scrutiny. But Bittrex, which is a fairly large, long-standing exchange, right? They just decided we're stopping business in the United States. We're going to keep our global platform running. How many of those do we want? And I think to me, that's probably the thing that is impacting innovation in this space more than anything else. There is no lack of builders. There is no lack of people wanting to build. My students are excited by it. As I said, I teach a class every semester in an intro class in blockchain, and I could teach 3 sections of it and still have a waiting list every semester. That's how excited kids are about it. A couple of students actually just had a blockchain company funded by a venture capital company last week. I mean, there is a lot of excitement in the space. There's a want to build, but the environment is just doesn't seem to be facilitating that very well.
Yeah. So, Brian, any thoughts there, or Tom, on influences on your businesses?
Yeah, I agree. Innovation and companies are being driven outside the U.S. because of the regulatory environment. So a great example is Coinbase. Coinbase went public 2 years ago. The SEC approved their registration statement. They went public, and now the SEC just sent them a Wells notice a few weeks ago, telling them they're running an illegal exchange. 2 years ago it was fine. Now it's not. And, Bittrex, they announced, like you said, they're moving overseas. So there's no regulatory clarity. And so I think it boils down to a turf battle between the SEC and the CFTC, trying to decide who's going to regulate this industry. But if you look back to 2014, we already have regulations. Back in 2014, Congress held hearings whether or not to outlaw Bitcoin and blockchain technology. And Congress decided not to because, one, it would drive the innovation outside the US. But two, they also found out that back in 1997, there was a court case called Bernstein versus the DOJ, where Bernstein wanted to export cryptography software outside the US, and the Department of Justice sued them, or the Department of Defense sued them. And so the Department of Justice took the case, sued Bernstein to prevent this exportation of software outside the US. And the court system decided that software is speech. It's protected under the First Amendment. You can't outlaw software. You can't, it's like outlawing Spanish. You just can't outlaw speech. And so that set precedent back in 97. So all Bitcoin is and all blockchain technology is software. It's cryptographic software. It can't be outlawed. And so, but the regulators and, the government, they're trying their best to suppress the industry. They tax Bitcoin as property instead of currency. So most of the world taxes Bitcoin as currency. So it's, you could exchange euros for Bitcoin and Bitcoin for euros. You don't have to, file a tax return for that. You exchange dollars into Bitcoin and Bitcoin into dollars. You have to file a Schedule D on your IRS form and show what you bought the Bitcoin for, what you sold it for, and if there's any capital transaction on that, any gain or loss. And so, the U.S. government's actively trying to slow down the adoption of this technology, and it's forcing developers to move overseas.
Yeah. So maybe I'll add on to this. You just mentioned, Brian, an active move to try to slow down adoption. I guess, we're seeing that in practice, but what's the why behind that?
It's the banking industry. It's the banking lobby, banking industry. So I'll give a great example. So Voice over Internet Protocol, VoIP, came to existence about 18 years ago. And before there was Voice over Internet Protocol, we used to use long distance companies to make phone calls, right? I'm old enough to remember I used to get a long distance phone bill, right? Why don't we pay long distance phone bills anymore? It's because we have this technology that basically allows us to do voice communication for free over the internet. So companies like MCI and WorldCom, their business models evaporated overnight because of a piece of software. The same thing's going to happen with the banking system. We have software now that allows us to do financial transactions for basically free. And so banks and other financial institutions that derive the majority of their revenue from charging a toll or a fee to do a financial transactions, their business models are in jeopardy. And so that's why they're fighting it. That's why they're funding the lobbyists to protect their turf. And, you can only protect it for so long. And then eventually it's going to break through. And, the world will be on a blockchain standard and not a, Bank of America or Wells Fargo or JP Morgan standard like we're on today.
Interesting parallel back to the long distance companies. And I am also old enough to remember MCI and WorldCom, long distance carriers and whatnot. So I think that's a really interesting parallel. So that's great. So one thing I'd like to do is I want to transition a little bit, if it's okay, into kind of some discussion around how Bitcoin specifically may fit into a portfolio. And Brian, you provided some slides. I'm happy to show them and kind of walk through some of that. But maybe we'll start with the general question. What do you see as some of the key drivers for inclusion with Bitcoin into a potentially diversified portfolio? And I'm happy to show the slides as well, if that's helpful.
Sure. So back in 2018, the Federal Reserve Bank of St. Louis came out with a white paper. And in their white paper, they said that, Bitcoin will emerge as its own asset class and thus have the potential to develop into an interesting investment and diversification tool. What they meant by that is that Bitcoin, when you add it to a diversified portfolio, it increases the Sharpe ratio because it's a non-correlated asset. If you look at Bitcoin's correlation versus traditional asset classes like stocks, bonds, real estate, cash, gold, commodities, it has a very, very low correlation to those. And so when you put a small amount, like 1% to 2% of a non-correlated asset into a investment portfolio, even though it's a very volatile asset like Bitcoin, if you size it correctly, that small amount will actually increase the Sharpe ratio. It will increase the risk-adjusted returns. And that's what the Federal Reserve said, 5 years ago. And so here's the data that supports that, that's been updated. So you could see, a 2% allocation to Bitcoin, a 5% and a 10% allocation, which is 5% Bitcoin and 5% the top 10 crypto assets. And as you add more and more crypto or Bitcoin to your portfolio, your Sharpe ratio goes higher and higher. And as a CIO or a fiduciary, most people have a fiduciary responsibility to increase the Sharpe ratio, increase the risk-adjusted returns. So as portfolio managers start to understand that adding small amounts of Bitcoin to a diversified portfolio increases the Sharpe ratio, then I think they're almost under a fiduciary responsibility to do so.
Very interesting. I think what's interesting too, and here's maybe a few other reasons why we don't have to touch on every single one of them. What's interesting too is I think the investment thesis around Bitcoin, at least and this is my own personal work and research and whatnot, you could really, like a few years ago, you boiled it down to inflation hedge thesis, asymmetric return thesis, diversification thesis, exactly what we've spoken about here, and others. But diversification, I think in this day and age seems to be the way the majority are leaning with respect to, can I rationally include this in the portfolio? And I think amongst our wealth management clients, so it's been a bit slower to adopt. And I think that's for a variety of reasons. It's education being one, it's reputational risk, it's regulatory clarity. I think there is a view and a desire to learn more and an acknowledgement that diversification is a potential benefit from inclusion. But I'm wondering, any other drivers, in your opinion, for including crypto or digital assets in a portfolio beyond diversification?
Yeah. So the last one is protection against economic uncertainty. So we see that today. We see major banks in the US failing because they're insolvent. They have a duration mismatch. And then you have all the commercial credit issues or commercial real estate issues that are come due over the next year or two. And I'm not saying this will happen, but I'm saying there is a small chance the entire financial system may just blow up. This fiat system this experiment we've been on for 52 years may just blow up. And if it does, what's your insurance policy? How do you protect yourself? Well, if you put 1% of your portfolio in Bitcoin, to me, that's like insurance. And so let's say Bitcoin goes to zero and everything else does fine. Well, 99% of your portfolio did fine and the 1% went to zero. And if you're an investor for a 10-year period and that 1% went to zero, 1% over 10 years, your returns, instead of being 6% on a balanced portfolio, it was 5.9 or 5.9%, right? You gave up 1/10 of 1% per year for 10 years for that insurance protection. But if the whole system blows up, that 1% in Bitcoin will represent more than 100% of your current portfolio because it will become the new financial system. And, that's the way I look at it. Is it's almost like insurance protection against this economic uncertainty that we're about to experience.
Very interesting. Tom, any perspectives on this?
Yeah, I mean, I agree with everything that Brian said, and we've done some studies ourselves on the sort of the portfolio allocations that come up with the same result. I would maybe just to zoom out a little bit, I want to focus for a moment on the second point here, which is the S-curve analysis, the mega trend. And I think if we think about blockchain technology, and this would be inclusive not only of Bitcoin, but other assets such as Ether and other layer ones, and effectively the ecosystem, there's a school of thought that might say, look, is this the fourth major technology wave in modern history? We had the PC revolution, then the internet, then mobile. If you believe in the transformational aspect of this technology, these are all public networks. Anyone can build applications on top of them. It does get very interesting if you think about the space from a tech investment standpoint, which is to say, if you want to play this trend and you believe in what I just said, that this is a major technology wave that will transform many industries, yes, there are companies you can invest in that are building in this space, but the way these things operate, they're not corporations. The value accrues at the protocol level in the native token. Mm-hmm. And then in the app token level, the application is built on top of it. So I think there's another lens to look at, which is more from a sector standpoint, which is if you believe in this trend, then, and it is going to change all these industries, then you have the ability to participate natively in this space, but it's not going to be through public equity. It's going to be through owning some of these native assets on these blockchains. And so in some respects, this looks like a liquid public venture market. You're going to see lots of failures, some massive successes. And the difference this time, unlike the 1990s, when everything was done privately, these prices are visible on a screen, and anyone with a crypto wallet can buy and sell these assets. So I think that's another thing that people should keep in mind. And I think the framework for evaluating these assets and their fundamental value is still developing. There's no canonical, Graham and Dodd for crypto. It's being developed, and I think that's something that people should be watching as well.
Yeah, very interesting point on the what I would call the fundamental valuation angle, and it being very nascent. And I can even recall in 2016 I was operating at a large quant trading firm, and some of the initial thoughts, we were very involved in the space. Some of the initial thoughts were going back to the equation of exchange, MV equals PQ. And I think we've evolved further from there as far as how to value a network, but still very nascent. And I think that, potentially that lack of a fundamental means of evaluating things, or even a canonical way adopted across the industry to value those things is probably something that's holding us back a bit. But again, I think over time that likely changes. But Jim, any thoughts?
I think Tom brought up a couple of things that the technology, kind of focus on the technology, focus on some of the companies building the technology. I think that as we move further, there is a high probability this becomes the fourth wave, and I think it's kind of already here. But you are seeing some really unique companies building things, and we are starting to coalesce around certain things. I know that a couple of people have mentioned the idea of protocol, and I would say, protocol is a little bit different. I would say that there are some things that are almost being treated like operating systems. I mean, how many things are now EVM compatible? I mean, when people are talking about, new chains or new products, oh, it's EVM compatible. And so is Ethereum going to be it? I don't know. I doubt it. I think there'll probably be more than one. But we are starting to see this coalescing around certain things. But that investment in the technology side and what that is facilitating, in particular in known industries and known processes, those are, I think, if you focus on that side of it and investment in that side of it, and how that translates into some of the digital assets, that's it's a really interesting place, and it's an intersection that doesn't exist in other types of assets. You get a much more direct look at things. The fact that it is transparent and you do have the opportunity to look into things in a different way. Again, that seems to be eliciting a lot of excitement out of people. The fact that it is open source and pretty much anybody can build on it, which is really nice.
Yeah. Excellent. Thank you. And Brian, thank you for the slides and the walkthrough. We do have a few questions that have come through from the audience. So maybe it's a good time to take one of those. And there's a bit of a theme here. It's related to ESG, environmental, social, and governance. And I'll read one of them. Is Bitcoin improving ethically? Is it shedding perceived problems having to do with energy usage, environmental impacts, and criminal activity, e.g. money laundering? So a bit of a loaded question there. It's a lot to unpack, but maybe we focus on the ESG front and maybe the perception of high energy use and the implications for the environment, et cetera. Maybe Brian, I know you're really focusing on Bitcoin. Curious to start off with your views on ESG and really Bitcoin mining.
Yeah. So all this stems from the misinformation campaign that's out there about Bitcoin. If you look at the facts, so I'm a guest lecturer at the Judge Business School at Cambridge University. Cambridge puts out data through their Center of Alternative Finance about Bitcoin mining, the environmental aspects of that, and the carbon footprint. If you look at Bitcoin's carbon footprint, it's about 1/3 of what data centers are. So if you look at Amazon Web Services, if you look at Bitcoin mining and data centers are about they're very similar industries. And so, but Bitcoin mining is 1/3 the carbon footprint. If you compare Bitcoin mining to air conditioners, it's about 1/10 of what air conditioners are. We don't have to use air conditioners. We choose to use air conditioners. Where I think the ESG concerns comes from people who don't understand what the value of Bitcoin is. They think that Bitcoin's worth nothing, so you shouldn't use any electricity to process transactions through the Bitcoin network. And that's just, it's unrealistic to think that Bitcoin's worth nothing. The reason I think they think that is they don't understand it. And so it goes back to one of the slides you had before, the misconceptions about the industry. I just, when I first learned about Bitcoin in 2014, I thought it was a total scam. I come from traditional finance. Bitcoin was 100. I saw Cameron and Tyler Winklevoss on CNBC talking about it, and I thought it was like a pump and dump scheme. But I did devote the time to understand it. And, I've spent thousands of hours, understanding this over the past 9 years. And the more you understand what this technology could do for the world, the more you get, you get drawn into it. And so I just beg all your viewers to don't dismiss it. You can go to a website called hope.com, and hope.com is a website dedicated to Bitcoin education. And go and just educate yourself, and you could understand, the ESG concerns and look at the actual data that shows it's just not true.
I would just, I think Brian said it really well. I would also focus a little bit, and I think he was alluding to this on the S and the G, right? There's a lot of focus on energy consumption. And I think, based on the data that Brian cited and other available data, Bitcoin is in some ways a greener industry than most U.S. industries in terms of its energy mix and focus on renewables. When we think about the S and the G, we should also remember that, again, an open, non-sovereign, censorship resistant network for monetary value transfer is a pretty significant public good, perhaps not in the United States or where we have, reasonably stable economies and currencies. But if you see where Bitcoin has been adopted as a means of payment or value exchange, it's in many countries that have pretty challenging macro conditions, places like Argentina, certain countries in Africa. And so I think that, it's important to look at this from a global perspective, not just a U.S. perspective, where to Brian's point, there are probably a lot of people saying, like, why do we need this? What is it good for?
Yeah, I think Tom, that's a fantastic point. There's a focus on the E in the ESG, and sometimes there's limited understanding of the net benefit on the S and G side, even if we can argue about the E side of it, one way or another. Brian, I think you brought up some very great points. But maybe Jimmy, any thoughts here? Your students, does this topic pop up?
The topic pops up on a very regular basis. They are probably more sensitive to it, just given their age. And we are seeing changes, right? I mean, Ethereum went to proof of stake last fall, and cut energy usage by over 99%. In Bitcoin isn't really engineered in such a way that you can do that, but there are efforts being made. People are paying attention to this. But more to Tom's point, I mean, you have to look at the other social goods that have come out of it. We talk about this quite a bit, the use in crisis, and we've seen the ability to make payments and things like that by the U.S. government to other governments, to other people in countries that are, maybe the countries or the governments aren't friendly, but people are working towards certain social goods, positions in Venezuela and things like that. Well, how do they get paid? They got paid with cryptocurrency via U.S. government. There are a ton of social good out there, and so I think sometimes that's kind of lost in the wash. And I know we're going to talk a little bit about some of the nefarious activities too.
So, Jimmy, you just brought up a really good point: the ETH moving over to proof of stake and dropping energy consumption by 99% versus a proof of work consensus mechanism. We just got a question through. Is there any sense whether it's proof of work or proof of stake, and which will dominate going forward? And I think it's a tough question to answer, because I think you got a variety of different use cases that makes sense for proof of work versus proof of stake, and a lot of ancillary, maybe opportunities for yield generation and proof of stake, and we can get to that in a moment. But just curious for thoughts on that.
I mean, I think that,
Brian, I know you'll have a good perspective on this one.
Yeah, no, I think that we're going to see I don't know that there's going to be an answer. I think because we're starting to see that we're at this place now, we're starting to see more like hybrid chains and things like that too. And as we have more provisioned and private chains in use, then the opportunities change, right? The opportunities proof of work versus proof of stake change. Proof of work is obviously that was what was in the white paper, and a lot of people think, well, if you vary from that, it's no longer blockchain. But sometimes things do mature, and usage and things like that. But it's interesting, in the abstract of the white paper, CPU usage was brought up not once but twice. So this was by the authors of the white paper. I mean, this was something that was known. It was recognized. I don't know that the extent was recognized, but it was certainly something that was not like an unknown. It didn't come out of left field for folks. So I would think that there's room for both, and we probably will see both. I mean, here we have the two largest coins in circulation, right? And using two different methodologies.
Yeah. Brian, thoughts?
Yeah, so they're trade-offs. So proof of work, proof of stake, you have to examine what you give up. So proof of work protocols like Bitcoin constitutes 96% of the proof of work protocols. So there's Bitcoin, and then there's all the other little ones like Dogecoin and, Monero, Zcash, but Bitcoin's 96% of the proof of work blockchain. So Bitcoin's the dominant one, and it will eventually be 99.9% of proof of work blockchains. So Bitcoin already won its category. Proof of stake blockchains like Ethereum, it's up for grabs. So we don't know who the winner is going to be for proof of stake. And then even if you dive into proof of stake versus proof of work, they're completely different. Proof of stake is more like a software operating system. And what you give up with proof of stake, you gain energy efficiency, but what you give up is control and decentralization. So Bitcoin is fully decentralized. There's no CEO of Bitcoin. There's no board of directors of Bitcoin. It's not controlled by anyone. Whereas a proof of stake protocol like Ethereum, it's centrally controlled. The Ethereum Foundation hard forked from proof of work to proof of stake. It's controlled. About 5 or 6 years ago when Ethereum first came out, someone hacked $60 million out of the DAO. And what Ethereum did, what the foundation did, they decided to hard fork it and put that $60 million into basically what's called a side pocket. And so now you have Ethereum Classic, which is the original proof of work Ethereum. And now you have the proof of stake Ethereum, which is, ETH. And so Ethereum is centrally controlled. And so I think that's one of the reasons governments kind of like Ethereum, is because if they need something done, there's people to go to and they could actually get things done. Whereas no one controls Bitcoin. It's fully decentralized. No one controls it. There's no way to manipulate it. And there's no way for governments to, like I said, to control it and force things on the population.
Interesting. Tom, any thoughts before we move on?
No, we can move on. I have nothing to add. I think Brian said it very well in terms of the differences and the trade-offs.
Great. Thanks. I want to talk about we had mentioned before, and Jimmy brought this up, doing some work and studies on the derivatives market within crypto. And so derivatives mean a number of things, right? New ways for exposure, leveraged ways for exposure, but also means to be able to capture both the upside and downside of price movements in crypto assets, among many other things. So, in my view, I remember 2016, I was helping operate and build a crypto trading desk. And into 2017, I guess it would have been early 2018, CME listed futures for Bitcoin came out to the market. And that also, I'm not saying there was causation, but there was a correlation with a steep drop in crypto asset prices at that time. And it's not to say they were correlated by any means, but I think, at least in my view, we've seen offshore exchanges offer perpetual swaps, if you will, which are AKA a different way of saying a futures contract, operating a bit differently. In the U.S., we haven't seen that grow, and that may be because of a regulatory piece, but I think we've seen volumes on the CME kind of pop. But curious about your views on the derivatives market, and not only from where we're seeing that market go in the U.S., but leveraging futures for risk management purposes within the context of digital asset crypto investments, specifically Bitcoin and ETH.
I mean, I think that it's kind of like when, and I think Brian may have alluded to this, when the U.S. came off the gold standard in the early 70s. Milton Friedman wrote a couple of papers on the need to develop very quickly a robust derivatives market to basically flatten out the dollar, right? So it wasn't a volatile asset, and we'll never know if that was the reason, but obviously it's worked out okay. I think the same thing needs to be done in the crypto market. And while there are some derivatives out there, you can buy a lot of DeFi derivatives. A couple of the big exchanges, Binance is probably the biggest, have options. There's not a lot of science around the pricing and things like that of those. And I know they claim to use Black-Scholes. They don't. I can show you that 50 different ways to Sunday, but I've been kind of working on this problem for about the last 18 months with a couple of other people, how you would do this. And it's a very different kind of market because it is very fragmented. There is no such thing as a central order book or anything like that, not even a consolidated tape. And so, and the future that's listed in Chicago kind of runs into the same problem, right? There isn't a price, there are 6 prices that are, basically integrated every day, and that's how they come up with the pricing. I think the same thing, the same influences that we've seen on other traditional assets, we will see on crypto once there's a chance to, kind of hedge out some of the volatility, and we'll see things flatten out. To date, that hasn't been done because there's been a rush to, sell things, honestly, to in particular retail investors, and so there are things out there. But from my experience and from our observations, they're not terribly well priced for the most part, because there are some kind of core things around around crypto and digital assets that I don't know that we can say yes, this exists. So things like a risk-free rate of return, or to pricing a lot of derivatives, right? But is there such a thing as a risk-free rate of return in digital assets? People tell me, well, it's staking on this, staking on that. It's like, that's not risk-free. Trust me. Trust anybody who's ever been caught in a downturn. Even more core things to finance. Is there a time value of money when it comes to digital assets?
Right.
So those kinds of core questions. But it's something that I've been working and spending a lot of time on. We've written a couple of papers on kind of leading up to our steps leading up to this. And so it is I think it's something that if we're going to see the digital asset market as a marketplace evolve, digital asset, derivatives and a very formalized derivative products have to be the next step. I don't see it going any place without that. I don't know what you guys think.
Brian or Tom, are you seeing the derivatives or entertaining questions amongst your clients, LPs, or other customers on this subject? And I'll just add, we just saw Coinbase launch its own derivatives platform. Now we'll see how that goes. It's certainly offshore, but it seems like we're moving in that direction. But just curious.
I would agree, and I do think it's needed also.
Yeah, I agree. I mean, if we play on this thesis of like, the next asset class, there will need to be robust liquid derivatives markets alongside the spot markets. We see limited interest from our clients in derivatives at the moment. They tend to be mostly hedge funds and others who are applying more sophisticated trading strategies. I would say, since we're still in the infancy of this industry, most investors want just pure long exposure.
Makes sense.
They're following a trend. I think in the U.S., outside the U.S., as Jimmy mentioned, you've got pretty reasonably well-developed derivatives exchanges in crypto. In the U.S., we don't. We had a couple of swap execution platforms, LedgerX, which I think was bought by maybe FTX. The Chicago Board Options Exchange bought a crypto exchange called ErisX, still in spot, but one might imagine in the fullness of time, just given their pedigree, they would think about doing this in crypto again, subject to regulatory clarity.
Yeah. Thank you. So I want to be conscious of time. We've received a number of questions from the audience, and so keep those coming. But maybe I'll do this because we have, as I mentioned, three tremendous thought leaders in the room. What advice would you give to those interested and think students within their existing careers thinking about this topic? Maybe there's an interest in digital assets and blockchain coupled with finance. What advice would you give them about what to do now to get involved in the market or get involved in a career, whether it's on the investment side in digital assets or on the development side and the building side? And so, Jimmy, I'll start with you.
Yeah, get your hands dirty. Get out there and start doing stuff. Don't sit on the sidelines just reading. Actually, get your hands dirty. Learn some Solidity coding. Experiment a little bit. I mean, there are a lot of courses out there. The courses on Coursera. Go out there and do some simple smart contracts. Use Gnosis Safe. Use some of the test nets. Horizon has a great test net that you can use. Start actually working in it. Start using it. And if you have a finance background or a technology background, I think there's a lot of room here. I mean, just tons of room to start doing it. Don't be dissuaded by the regulatory environment that we're in right now. That will change. Don't be dissuaded by those that say this is a passing fad. It's not. I think for students in particular, this should be really, really exciting. I'm seeing students, creating companies and doing really cool things in the space. But I would say don't sit on the sidelines and read books and articles. Start getting your hands dirty. It's not hard to do. And I'll even throw it out there. If you need ideas, call me. Send me an email. I'm more than happy to give you info on what some of our students are doing. We're being approached, I would say, from the professor side, and hopefully there are a number of professors on here. Start calling up companies that are doing that have been very, very public about working in the blockchain space. Call up the Ethereum Foundation. They always have projects and things like that. Get your students involved in this. This is an emerging technology. Get your students involved. I mean, I know that Fidelity has a pretty robust. I mean, I've actually had a couple of students go to work in the digital asset space at Fidelity, which is great. But the same thing at Onyx, JP Morgan. I think they have 300-400 people now in the Onyx division. I mean, there are a lot of traditional financial services firms that are looking for people with this experience. So go out there if you're a student and grab that experience.
Yeah, I love that. I love that point of you made of not only don't just read, don't just watch YouTube videos, get your hands dirty, get involved and interact. And I think that's how a lot of us who were, I don't want to say early adopters, but early-ish entrants into this space really got working. We got our hands dirty, whether it was transacting in a market or learning about DeFi and getting involved there to whatever extent, or learning, to your point, a bit of Solidity and starting to interact with smart contracts. Fantastic. Tom or Brian, any other views there? How to get?
I agree with Jimmy. Go out, get your hands dirty. Go to blockchain conferences. There's one in Miami, May 18th through the 20th, called the Bitcoin 2023 conference. There'll be thousands of people there. Go there, meet people, get involved. If you're a student looking for a job or an internship, I have two resources. If you Google Polychain jobs and DCG jobs, you'll see two websites that pop up, which are consolidated websites where these are two companies I'm involved with, where we consolidate all of our job openings for our portfolio companies. We have over 2,000 job openings in the blockchain space. So Polychain jobs and DCG jobs. And you could sort, and see if there's a fit for you. Yeah. If you're an asset allocator to the space, I beg you just to educate yourself. If you don't have your clients allocated a small percentage to Bitcoin, you're doing them a disservice. You need to educate yourself so you can properly advise your clients. And like I said earlier, even the Federal Reserve Bank of St. Louis said that Bitcoin is a portfolio diversification tool, and you need to size it appropriately for your clients. But you just have to educate yourself. And just one important point I'd like to make: Bitcoin and these assets, they're not trading vehicles. They're long-term investments meant to hold for 10 to 20 years. If you look at the performance of Bitcoin, all the performance comes in 10 days. So if you think about it, 3% of the time that you own Bitcoin, you're happy. The other 90%, 97% of the time, it's either flat or going down, because all the performance comes in 10 days a year, which is 3% of the days. So you can't time it. So you just own it. You make an allocation to it. You hold it for the long term, and you just think of it as long-term property ownership.
Very interesting. So I want to thank our panel here. Again, privileged to be able to moderate this session, and I know I got a lot out of this, and I'm sure the audience did as well. I think Jimmy mentioned this, and I want to open up to myself too. If you have questions, if you have thoughts, if there are items you'd like to speak with, I'm open to that as well. I won't speak for Brian and Tom, but I'm sure they are as well. But hopefully this was of value, and I appreciate everyone's. I think we had 250 participants, so that's a pretty good turnout for, I think, what was a pretty special session. So with that, thank you, everyone. Edwin, I'll hand this back to you.
Appreciate it, Brendan. And thank you, Tom, Brian, Jimmy, as well for your contributions today. I think, obviously a very exciting and topical theme for us to tackle, and one that's certainly not going to go away. And so I think that's a good opportunity for us to cover that. So thank you all for your thoughts today.